Welcome to The Explainer. Today we're going to tackle a really critical but often overlooked risk that can completely derail a retirement plan. It's this fascinating idea that explains how two people can do everything right, and I mean everything, yet end up in completely different financial worlds.
Okay, let's just jump right into it with a quick story. Meet Chloe and David. Now look at this. On the surface, their retirement plans are identical. They both start with a cool $1 million. They both plan to withdraw 4% every year to live on. And over the long haul, their investments both average a solid 7% return. But look at the end result. David is doing just fine, totally financially secure. Chloe, she runs out of money.
So how is that even possible? It just doesn't seem to make sense, right? Same starting point, same withdrawal strategy, same average return, yet one plan works beautifully and the other one fails. Well, solving this puzzle is exactly what we're going to do today. The answer is hiding in a variable that becomes incredibly dangerous the moment you stop saving and start spending.
That secret, that hidden factor behind Chloe and David's very different stories, has a name. It's called sequence of return risk, and it truly is the overlooked factor that can change everything for a retiree.
So what is this thing exactly? Well, sequence of return risk is the danger that the order, the sequence in which you get your investment returns can have a huge effect on how long your money lasts. And what's so wild about this is that the average return over, say, 20 or 30 years can be exactly the same for two people. But if the bad years, the down years, happen right at the beginning of your retirement, oh man, it can be devastating. It's not about the average, it's all about the timing.
Let's make this real. Look at David's retirement. He got lucky. He retired right into a strong market. In his first few years, he's getting these great positive returns. So his $1 million portfolio is actually growing. When he takes out his 4%, he's taking it from a pot that's getting bigger. The market gains are more than enough to cover his withdrawal, leaving his money in great shape to keep on growing. No problem.
But Chloe's story, it's the exact opposite. She has the absolute worst luck. She retires, and bam, the market tanks. Her portfolio takes a big hit right away. The problem is, she still needs to take out that same 4% to pay her bills. But now she's pulling that money from a portfolio that's already shrinking, which just makes the damage so much worse.
And this right here, this is the absolute heart of the problem. When Chloe takes money out, she's forced to sell her investments when they're down, when their value is low. That means she has to sell more shares to get the same amount of cash. And that capital, it's gone. It's just gone forever. It leaves so much less in her account to benefit when the market finally does recover.
This dangerous mix creates a kind of a double impact effect. It's this 1-2 punch that explains why pulling money out of your accounts during a market downturn is just so uniquely dangerous for your financial future in retirement.
Let's walk through this downward spiral step by step. So first, the market goes down, your portfolio value drops. But, you still need to live, so the withdrawals continue. Third, those two things combine, the market losses and your withdrawals, and your portfolios start shrinking way faster than you'd expect. And finally, and this is the killer, your portfolio's ability to recover is seriously damaged. There's just less money left in the game to grow back, making it almost impossible to catch up.
Okay, I know that all sounds pretty scary, but here's the good news. Understanding this risk is the first and most important step toward actually managing it. You can build a more resilient plan. So let's shift gears now from the problem to the solutions and talk about strategies you can use to protect that retirement income.
I think this quote just perfectly captures the huge mindset shift that has to happen. When you're working, it's all about growth, growth, growth. But once you retire, the game totally changes. Protecting your income stream becomes every bit as important as chasing those high investment returns. So, what can you actually do about it? Well, it boils down to a few key strategies. First, it's a good idea to have different sources of income, not just your portfolio. Second, you want a good balance between those growth investments and more stable assets that can act as a cushion. You also want to try and create some predictable income streams to cover your must-have expenses. And maybe the most important one, you've got to be smart and flexible with your withdrawals. Maybe that means cutting back a bit during a really bad market downturn, if you can. You see how all of these strategies point to a really fundamental change in how you have to think? The goal in retirement just isn't about accumulation anymore. It's about building a plan that is truly sustainable for the long haul.
And that brings us to the single most important takeaway from all of this. Once you start taking money out of that nest egg, your goal has to shift. It's not just about making your portfolio grow anymore. It's about creating a sustainable income and actively managing all the risks, like this one, that could threaten it. And so, as you think about your own financial future, I'll just leave you with this one question to ponder. Is your current plan designed only for growth, or is it truly built for resilience? Knowing the answer to that could make all the difference in the world. Thanks for tuning in.